So, hi everybody, this is Hub. I'm Giacomo, and today I'm again with Jordan Lambert, the CFA Chartered Managing Director of Convequity. And today we're going to talk about Palo Alto Networks. So, this is a continuation of the cybersecurity stock analysis. So, you can find the whole playlist on the channel. This is just a comment on the latest financial results of Palo Alto Networks. If you want to get a better understanding of the underlying business, we did a full fundamental analysis last year on Palo Alto Networks, so make sure to check out that video as well. The link will be in the description, and also check out the previous videos we did this year. We covered Cloudflare and made a comparison against Zscaler, and we also did a full covering of the cybersecurity landscape. So make sure to check out those videos as well. So Jordan, without any further, get into the content and show us what you have to say.
Right, great. Thank you, Giacomo. So, yes, looking forward to doing this Palo Alto Networks presentation for you because, as you just mentioned, the quarterly results were just released last Tuesday, and Palo Alto Networks is a major player in cybersecurity, so it's a good company to review as part of the cybersecurity series, and also we can kind of follows on from the first presentation we did within the cybersecurity series, where we was outlining the changing dynamics of the industry because of the Silicon Valley Bank collapse. So, yes, without further ado, so viewers, please pause for a moment and read the disclaimer. So Palo Alto Networks, it was kind of trading between 180 and 200, and then on the 23rd of May, it released its results after market, and we can see that it spiked from 190 up and above the 200 mark. So right now it's kind of trading at its 18-month highs, and that is because the company produced very solid results, just beating guidance on billings, reaching the top end of guidance on revenue, and also surprising on the margin side as well. So we're going to dive into why there's durable growth with Palo Alto Networks, and also why the margins are increasing. So as a recap on the long-term investment thesis on Palo Alto Networks. So Palo Alto Networks is the largest pure-play cybersecurity company around. They have a market cap of around 60 billion and trailing 12-month revenue of 6.5 billion. Its primary areas of cybersecurity are network security, endpoint security, security operations, and cloud security. And it's actually a leader in each one of these areas. So we've dived into these details in a previous video, but just to give you as a recap, network security is hugely important. It's a very innovative area of cybersecurity at the moment because network security, enterprises' networks have been going through a major transformation since COVID. Before COVID, you may have heard of the analogy of a castle and moat, where inside the castle would be all the data, all the systems, applications, web servers, etc., and maybe the headquarters as well. And in and around the grounds would be branch offices. And within those grounds as well, you'd have most of the workforce. And around the castle and its grounds would be the moat, and on that would be a security perimeter where you would have security devices like a firewall, and all traffic destined for that enterprise would go through the firewall. That firewall would inspect the connection, and whether it's a trustworthy connection or a malicious connection, and allow the connection to go through accordingly. So when COVID came and all the workforce suddenly wasn't inside the castle and moat anymore, and they was working from anywhere, and also the data was no longer inside the castle. It was also inside the castle, but also in the cloud. Well, that castle and moat framework completely obliterated itself. It could no longer withstand the new way of work. So SASE came into play, which stands for Secure Access Service Edge. We dived into the details in the previous Cloudflare presentation, so be sure to check that out. All these network security players in cybersecurity are promoting themselves as the number one SASE name. So it's undergone a major transformation, but there's still a lot of innovation to come out in this SASE market, and Palo Alto Networks is the leader. So now endpoint security, I'll be very brief here. Endpoint security is about protecting users' devices, whether it's laptops, PCs, smartphones, tablets. And it's very, very important because you need preventative and detective security for these devices. Because ultimately, this is where the bad guys, the cyber criminals, these are the things they try to compromise. They are trying to execute malicious files on these endpoints, trying to get remote command and control of these endpoints in order to move around the network. So hugely important, and endpoint security is going through a transformation from something called EDR to XDR, and Palo Alto Networks is a key player in that space. Security operations is kind of a backstop or a supporting role within cybersecurity, because cyber criminals, inevitably, they are going to eventually penetrate the enterprise's network, despite all of the security solutions that are in place. In order to carry on protecting the enterprise, you need to be proactive. So there's security operations consists of security analysts proactively hunting for threats, checking for unusual behavior that may not have been detected by the security solutions. So that's a very important area. And automation is transforming security operations. And this is one of the points we're going to discuss in this presentation. So automation is driving security operations, and Palo Alto Networks is a leader in automation at the moment. And then you've got cloud security. So cloud security became hugely important as enterprises reacted to COVID and needed to store more applications and run more applications and build more applications in the cloud. Developers kind of ran rampant, building up, being very innovative and building all these applications, but without really thinking about security. So it's left a lot of enterprises operating in the cloud very, very vulnerable. And cloud security is important to close up them vulnerabilities. So, and Palo Alto Networks is, again, a key player in this cloud security space with the broadest platform around. So that's a quick overview of the areas that they are leaders in. The main driver for the long-term thesis is consolidation. So consolidation from a market perspective, that the enterprises need to begin consolidating how many cybersecurity vendors and solutions they have. But also consolidation in terms of competition, some competition getting wiped out because of the venture capital funding drying up and the Silicon Valley Bank collapsing. So we dived into those details in a prior presentation, so be sure to check that out. So ongoing consolidation is a key catalyst for Palo Alto Networks' durable growth, even through the macro headwinds at present. And for several quarters, Palo Alto has been increasing margins. And due to the potential operating leverage, it will be able to continue pushing its margins higher in quarters and years to come. Lastly, we would say compared to peers, it could be argued that Palo Alto Networks is trading at roughly a fair valuation. However, there is the argument that there is upside, especially when you consider its elite rule of 40. So we'll take a look at that in the upcoming slides. This is an overview of Palo Alto's third quarter results. So total billings came in for the quarter at 2.3 billion, growing 26% year on year. That slightly beat the guidance that was given. Remaining performance obligations growing even higher, 35% year on year. So remaining performance obligations is essentially deferred revenue and also backlog. So amounts that have not been invoiced yet, but are still being signed into contract. And then we have NGS ARR, which stands for Next Generation Security Annual Recurring Revenue. This is it's at 2.6 billion at the moment, growing 60% year on year. And really, it was only created in 2019 when Nikesh Arora, the CEO, he came to Palo Alto in 2018 and quickly developed this new division, a purely cloud-native, cloud-focused division. And yeah, this could be a startup in itself. Well, very, very big startup, but yeah. So, and this NGS division is really not just driving growth higher, but also driving the margins higher, which we'll dive into in a little bit. And total revenue is 1.7 billion, growing at 24% year on year. And quite impressively, not only is Palo Alto Networks managing to continue growth in the mid-20s to 30s region, it's also generating substantial operating leverage. And actually, we can see here that the free cash flow has actually been growing 68% year on year. So growth and leverage at the same time. And we think this is going to continue because of consolidation. This is a table of data we like to put together when we are reviewing quarterly results. We can see over the last 9 quarters, Palo Alto's growth has just been very solid. It's just been in the mid-20s to 30% year on year. And this is quite contrary to other leading names in cybersecurity, that perhaps Zscaler or Cloudflare or SentinelOne. They started at a higher revenue growth because they had a lower revenue base, and we've seen their growth decelerate quite sharply. They're still growing at around 30% and above, but the deceleration has been quite sharp, and that's what has put some investors off. Palo Alto is completely different. Right through COVID, growth accelerated a little bit during COVID, but then it's just maintained that growth between mid-20s to 30%. And again, this is because of the consolidation factors that we'll get into later. Also, we like to do the annualized quarter-on-quarter growth. Sequential quarter-on-quarter growth, it does have a lot of seasonality, so it can be volatile, but nonetheless, it is quite useful to observe. So if you annualize it and then compare it to the normal year-on-year growth, you can see that in the fourth quarter, the column highlighted in red, Palo Alto Networks expects annualized quarter-on-quarter growth to be 54%. So they're going to be going, that they're not going to be able to maintain that all year round, but it just shows you that going into the end of a fiscal year, which finishes July 31st, they're going to be performing quite strong. So yeah, interestingly, not on this table, but you can see that revenue growth is from the peak in the first quarter of 2022. Revenue growth has been decelerating slightly by about 6%. But actually the deferred revenue balance, which we don't actually have here, has been increasing. And that's quite interesting because it aligns with the notion that Palo Alto Networks is landing larger and larger deals with enterprises that are spread out over more years. So it's not impacting because of the accounting standard ASC 606, which is a revenue recognition accounting standard. Because of that, these larger and larger deals aren't going to show up on Palo Alto Networks revenue instantly. It will be spread out over the duration of the contract, but it does show up on the deferred revenue. So that's another reason why the cash flow is so strong, because more deferred revenues coming in immediately because of these bigger deals, but also over the long term, over the next quarters and even years, revenue is well supported. So very, very interesting. And yes, we can see NGS, the next generation security, we're still growing at around 60% year on year. We can see that the gross margins at GM, non-GAAP GM and GM, both kind of over the last 9 quarters have been steadily increasing. And it might not look like a big increase, but it is quite difficult to increase your gross margins because it is your core economics, your core unit economics. And we're going to explain why the gross margin has been increasing. And yeah, so just generally very, very solid, and been managing to maintain a very healthy rule of 40. Some quarters it goes really, really high, but generally on a trailing 12-month, the rule of 40, it tends to be around 60 or above. So rule of 40, for those who are not familiar with it, is a combination of growth and free cash flow margin. And it's quite a good indicator to assess companies whether they're balancing growth and profitability or cash flow profitability. So, right, so what's driving the growth? Right, well, the market dynamics are driving the need for consolidation, the macro, the complexity, startup funding, and hybrid. I'll go into each of these. So the macro is driving Palo Alto Networks results, weirdly enough, because enterprises are under pressure to cut budgets, reduce spend, but also they still need to increase their cybersecurity. So we're in a bit of a difficult conundrum. They need to reduce spend, but also maintain cybersecurity because the landscape is very, very treacherous. It's very dangerous. Lots and lots of cyber criminals plotting attacks out there. So for those enterprises that have Palo Alto already installed within their environment, however small that may be, it gives Palo Alto Networks a big advantage because they can speed up the procurement with the enterprise because they're already in the enterprise, albeit it might be small. Palo Alto Networks has got a great reputation. There's some familiarity there. So instead of enterprises going through a proof of concept and a long sales process with a new cybersecurity vendor, which adds costs, it makes sense to speed things up and go with Palo Alto. They've already got Palo Alto products in their environment. So that's going to save them costs and also speed up their cybersecurity enhancements. Also, another reason for the consolidation is the complexity. So enterprises are probably managing between 50 and 100 different cybersecurity vendors and their solutions. It creates a lot of complexity. And this is because over the years, as enterprises, as new cyber threats have come into the landscape, enterprises, or should we say chief information security officers, they've tended to want the best solution to combat that latest threat, right? And usually the best solution comes from a small agile startup. So they'll say, right, I want that best of breed solution to fight this latest threat. I've got to have it. It's too dangerous not to have this best of breed solution. So over the years, enterprises have probably 50 to 100 different vendors and their solutions, all serving, to protect against a specific threat. But this paradoxically actually weakens the overall cybersecurity defense, because all these different cybersecurity vendors and their solutions don't actually communicate with each other very well. So enterprises, they need to consolidate, and that's what's supporting Palo Alto Networks growth at the moment. They need to consolidate because it's just too complicated. And then there is the startup funding squeeze that we went into when we did our first presentation in, I believe it was March. Was it, Giacomo?
Yeah.
Around March. So we did a couple of videos around the funding for startups, in particular early stage startups, was drying up because of the macro sentiment. Venture capitalists were slowing down their investments, and then the Silicon Valley Bank collapse, which just exacerbated the de-risking in the environment.
The trend that was already happening, right?
Yeah, absolutely. So really, there's a lot of early stage startups or startups in general that are going to run out of money. Since we did that presentation, there is probably already startups that have folded, startups that are competing against Palo Alto Networks. So because of this macro environment, it's actually clearing up the competition for Palo Alto and making Palo Alto an ideal choice. And a hybrid as well. Hybrid is there's cloud is obviously the main topic still since COVID. It's all cloud. But really, in reality, enterprises can't be 100% cloud. They have to be hybrid. So they still have some assets, systems, applications that they need to manage in their own data center, in that castle and moat. They also have assets in the cloud, in multiple clouds. So this is what hybrid is. It's a hybrid environment. And there's not many cybersecurity vendors out there that can provide this consolidation across a hybrid environment. There's pretty much only Palo Alto and Fortinet. So this is another big driver for Palo Alto. So Palo Alto's platform breadth with best of breed or near best of breed solutions included is really taking advantage of this landscape. It's being recognized as a leader in numerous high growth markets. So this has been taken, this slide on the right hand side has been taken from one of their investor presentations. And it just shows you that they are being recognized as a leader by the likes of Gartner, Forrester, GigaOm, whoever it may be, in various high growth and innovative areas of cybersecurity. And this is important because IT buyers, they refer to these reports from Gartner and others, and it helps guide their decision. And finally, what's driving the growth? Well, great leadership and business acumen from the CEO, Nikesh Arora. He's done a phenomenal job at Palo Alto. Because when he joined in 2018, it did look like they was destined to become a legacy network security only vendor. They just didn't really have a footprint in the cloud. They didn't know how to get that footprint. Nikesh came in and just decided, right, we can't waste any time building things in-house. We just need to be quick. And they made a lot of acquisitions. and that can be value destroying for shareholders. But what he did was he empowered the founders that became part of Palo Alto Networks, and gave them, allowed them to continue executing their vision, empowered them, allowed them to lead a team at levels not too far behind the CEO himself. So by doing that, it's really fostered a kind of startup culture within this NGS division. So very good, just brilliant leadership by Nikesh Arora. So yeah, let's have a look at what's driving the margins, because I think this is quite interesting. So Nikesh Arora, he refers to this consolidation play of Palo Alto's as platformization, and it really is working. I mean, we can see it in these numbers. So there's high growth in the number of accounts worth over $1 million, 29% year-on-year growth in the number of accounts. But there's even higher growth in the number of accounts over 5 million and 10 million. And this just shows you that consolidation for Palo Alto is real. It's not just speculation, it's actually happening. And this is great for margins, because if you as a company, would you rather generate 10 million from one customer, or would you rather generate 10 million from 20 different customers? Well, there's pros and cons to both, right? Diversification is important, but in terms of margins, you're going to make a lot more profit if you're getting 10 million from one customer than 10 million from 20 different ones. So this is what's driving the margins, and also driving free cash flow as well. Because as I say, a big chunk of this will go to deferred revenue, which is part of free cash flow. But on the longer tail, revenue is well supported when they're landing like 10 million, 15 million, $20 million deals. That revenue is really supported many quarters and years out into the future. And I think this is why Nikesh Arora has become more confident in the guidance that he's given. So at the end of the second quarter of the fiscal year, he actually gave guidance for the 2 consecutive quarters. So I think we might see more confidence in the guidance going forward. Yeah, this is one aspect of what's driving the margin, just bigger deals, bigger and multi-year deals. So another thing that's driving the margins higher, in particular the gross margins, is Palo Alto Networks since COVID has been selling relatively fewer hardware firewalls and more software firewalls. So one kind of a reason for this is during COVID, there were supply chain issues that we're all familiar with, and it made it difficult for enterprises to get these physical firewalls installed, and it requires so these enterprises, because they couldn't get the supply of these physical appliances, and they switched to a software firewall. So a software firewall, well, let's just explain what the implementation looks like for a hardware firewall or an appliance-based firewall. So you need to order something that looks like this, or a few of them, and you need to have somebody go down to your data center and have it installed into the server rack and connected and then tested. And then you have to do all this network configuration, etc. There's a lot of implementation costs and time and effort. However, if you just procure and install a software-based firewall, you can just do that remotely. You can just send a file to the server. It doesn't have to be a specific server. It can just be a commodity-based server, and then you have a functional firewall operating in your data center. So that's why software firewalls have become quite popular since COVID because of the supply chain issues. But it also drives Palo Alto Networks margins higher because the gross margin is lower with hardware firewalls. So this is quite interesting. And also more recently, because of the macro situation, companies are being put under pressure to lower down their capital expenditures. There's no capital expenditures at all by deploying a software firewall. And Palo Alto Networks has one of the best software firewalls around, and because of its presence in the cloud, I think now they're already like the leader in software firewalls by three times that of the whoever is second. So very, very impressive. So as more and more software firewalls become a bigger proportion of the overall firewall sales, then you could expect Palo Alto Networks gross margin to inch even a little bit higher than it already is. Also, what's driving the margins is automation. So Palo Alto Networks has been driving automation in its own company. There's this product called XIM, which it has been developing internally. What XIM is it's basically a replacement for a SIM. So just to explain what a SIM is, a SIM, which is spelled SIEM, is a security incident and event management system. Most enterprises need to have a SIM because for compliance reasons. And what a SIM does is collect logs from anywhere, like the network, a user's device, wherever it is in the environment, collects all these logs. And a log can be anything. It can be anything that's happened digitally in your network. Somebody logging into something, somebody connecting to something. It can be anything. And what a SIM does is collect all these logs, and then security analysts will use this information to try and detect if anything unusual is happening in the environment, etc., and do investigations if they've been alerted to any bad actor making it into their enterprise. What a SIM's not very good at, however, is correlating all these logs. So there's a lot of overhead that is required if you're going to use a SIM. If you're a security analyst, you have to do a lot of synthesizing, correlating the data, a lot of fine-tuning, configuration in order to make any sense of all these logs, in order to find where the threats are, where the vulnerabilities are, etc. What Palo Alto Networks has done with XIM is address those limitations of the SIM. So it brings in all the logs from endpoint, cloud, network, wherever it may be. But instead of just presenting it to security analysts as they are, it does a lot of work in correlating, synthesizing, and stitching them all together, and only presenting any alerts to security analysts that have a clear storyline. When did the cyber criminal first enter the network? What did they do? What path did they take? Where are they now? So a full visualization and storyline of each alert. And so Palo Alto's XIM was used in-house for several quarters, probably a couple of years. And then it was co-designed and refined with select enterprise customers. So it would have been quite battle tested. And interestingly, by using this, Palo Alto Networks' own security operations center has been reduced down to only 22 employees. And Palo Alto Networks has like 70,000 customers, right? Its devices are spread all across the world. And because of XIM, reducing the amount of overhead and reducing the number of alerts that are coming through, and only delivering the high fidelity alerts that really need responding to. They've managed to reduce what they need in their security operations center to 22 employees. This has driven substantial operating leverage right across, from gross margin down to the lower margin levels. So this, and interestingly now, XIM was released in late 2022 to the general enterprises, generally available. So this could be the biggest product of Palo Alto to date. Bookings for XIM is kind of doubling every quarter. The bookings are doubling, so it really could be transformational for many enterprises that are having a hard time using a SIM. Because it could provide them with the automation and the operating leverage as well. So it could be huge. Right, so we've just discussed what's driving the growth and the margins. Software firewalls versus hardware firewalls, the automation, and also, what did we say? Yeah, the larger and larger multi-year deals. So we think this is going to continue because of the consolidation. Consolidation seems to have gone up a gear in the last few months, and I think it will continue. So let's have a look at the valuation considerations. So you can see here, Palo Alto Networks is bolded. It's kind of on the line of best fit. We've got enterprise value to gross profit last 12 months on the y-axis and next 12-month revenue growth on the x-axis. And yeah, Palo Alto Networks in this group of 56 peers is just about fairly valued, you could say. But what I find interesting is comparing Palo Alto Networks against comparing its multiples in a rule of 40 context. So Palo Alto Networks, out of those 56 cybersecurity peers, Palo Alto Networks is only one of 4 players that have a rule of 40 higher than 60%. And you can see that if you take a look at their multiples, their enterprise value to sales, gross profit, and free cash flow multiples, they're not exactly cheap. But when you take a look at other companies with similar multiples but a lower rule of 40, perhaps there's upside, So yeah, we can see, for instance, we can see here that Synopsys, they have multiples similar to Palo Alto. 12 on the sales, 15 times on gross profit. But yeah, they have a rule of 40 that is quite a bit lower. So we can also compare this to a rule of 40 between 40 and 30%. And again, we can see, for instance, Microsoft, similar multiples on the sales and gross profit, but a lower rule of 40. So I think there's an argument that yes, okay, it is relatively speaking fairly valued, but if you dig into the details, maybe there's some upside. So let's just have a look at the DCF valuation. So firstly, we'll just have the main drivers for this valuation model is a very, very simple one, is revenue growth and free cash flow margin. And also stock-based compensation as a percentage of revenue, because our free cash flow margin, as you can see, there's an option to include stock-based compensation as an expense or not. If you include it as an expense, then what the model does is deduct that amount of stock-based compensation from the free cash flow. And obviously that is the conservative way to do it. So yeah, revenue growth, stock-based compensation, and free cash flow. And we kind of have the rule of 40 here as well as an anchor. And we can see here that revenue growth for fiscal year 23 is going to come in at about 25%. And we're kind of just declining the revenue growth steadily year after year. It won't happen like this. There might be sharp drops and then sharp recoveries, but generally for modeling purposes, we'll just steadily decline it. And it doesn't finish in 9.25 years. It actually goes out to 14.25 years. Okay, we will leave a link to the full DCF valuation in the description. So really, I've gone over this a few times. I think it's quite conservative. If you have a look at the free cash flow margin, it's currently the free cash flow margin on a trailing 12-month basis was 42%. It's not showing here, but so really, as the company starts to gain more operating leverage based on those drivers we've just discussed, I think free cash flow margin of 30-something% is very conservative. It could easily rise to 40% quite quickly. So yeah, on the whole, I think this is quite conservative, not massively conservative, but quite conservative. And it could be intrinsic value per share comes in at $314 per share, and the stock right now, last time I checked, was trading at about 210. So it might be considered a bit high. I'm aware of that, but in order for it to reach this intrinsic value per share, that would equate to enterprise value to sales ratio of 15x. And if you take a look at some other leading names like Cloudflare, maybe Datadog, that are considered, even Snowflake, that are considered leaders in cloud native security, cloud delivered security. If investors eventually appreciate that Palo Alto Networks is becoming a true pioneer in all things cloud, whether it's SASE or cloud native security, maybe that could push extend the multiple to these kind of levels. I'm not saying that is right or not, but if others like Datadog and Cloudflare are trading at these levels, why can't Palo Alto? But yeah, just take this with caution. Sometimes the DCF valuation doesn't always line up with what the relative analysis is indicating. But as I say, we will put the link to this in the description, and viewers can access the Google Sheets and copy and paste it into their own spreadsheet and play around with the numbers themselves. But yeah, based on this analysis, you could argue it's fairly valued, but I think there's upside. I think there's upside, definitely. And we've been saying since 2020 now that Palo Alto is destined to become the first $100 billion market cap pure play cybersecurity company. And I think they are well on the way to do this. If they actually extend their multiples to 15x for the sales and 20x for the gross profit, this would actually put them in that bracket, the $100 billion pure play cybersecurity company. So yeah, that's pretty much it, Giacomo.
So first question, real quick, is do you think, given this situation, the strength in the numbers that Palo Alto has, do you think the Moat is reasonably priced compared to the other players in this sector?
Right, good question. So Palo Alto Networks has a solid moat. I think Palo Alto Networks moat is driven in the culture and the the way the company is able to adapt to the changing landscape. I think that is its moat. It's driven by Nikesh Arora's leadership. It is able to identify what the latest trends are in cloud security, network security. If it can build it in-house, it can do that very, very well because it has a huge amount of talent in AI and in cloud security like containers. But if it can't build it in-house, it's not afraid to just go out and buy a best of breed startup and work on integrating that startup into its wider platforms, and not just plonking it in there, but actually integrating and having it come part of the platform. And as I said earlier, empowering these founders that join Palo Alto Networks to continue with their vision is also very important. And also the sales and marketing of Palo Alto Networks. They make the acquisitions of these startups and integrate their technology, but then they use Palo Alto Networks' prowess in sales and marketing to really make that acquisition fruitful. And also, it's just over the years, they've just got a sterling reputation in security. They are the gold standard for security. You know, yes, Cloudflare is a great company, huge amounts of talent, and they've got a solid moat as well. But when it comes to security, Palo Alto is the gold standard. So that in itself is a good moat.
Okay. And another question I have is, I think last time when we were talking about Cloudflare, you said that after a certain threshold, you are more likely to get government contracts. Given the fact that government spending is up, especially defense is up, do you think Palo Alto could have a role into this and gain some more government contracts?
Absolutely. Recently, they was accredited with IL5, which is impact level 5 for cloud security. So that just adds to their FedRAMP authorization repertoire. So yeah, because we mentioned before that the government agencies do tend to go for companies that are not like the best of breed and most innovative. They like to go for companies with more of a long-standing reputation. And so Zscaler is one favorite with the government because, as we mentioned in the Cloudflare presentation, we don't think Zscaler has the best technology, but it has the most battle-tested solutions like its secure web gateway. And that's what governments want. So I'm not saying Palo Alto Networks isn't innovative. It's highly innovative, but it also has a long-standing reputation, and many of its products have been battle tested for many years. So yeah, it should do well with any kind of dynamics in the government regards to spend.
Okay. So I'm done with the questions. Jordan, thank you again for your availability and your time. Make sure to like, subscribe, and yeah, we'll go from there. We'll come up with new videos on cybersecurity soon, so make sure to follow along. So
yeah, thank you, Giacomo, for having me again. And yeah, we'll produce some more videos on cybersecurity in a few weeks.
Okay, great. So this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.